Investing in dividend stocks can be a great way to create passive income. Many companies pay dividend versus investing that money back into the company. And of course, this gives an incentive for investors to actually put more money into the company. In today's video, we're going to be looking at 5 dividend stocks that are paying over 5% yields, which is kind of crazy when you put it in conjunction with the amount that we're seeing for CD rates, which is roughly about 5%. But when you also look at those high yield savings rates, similar to M1 Finance, they're offering 5% as well. And of course, with the dividends that we have within these companies, there's also a big opportunity for growth, meaning not only could you see the dividend return through the passive income, but you could also see the stock appreciation of the price. Now, when you think of the S&P 500, which returns around a 1.3% dividend yield, these are much, much higher than that. So let's go ahead and get into this list of the 5 dividend stocks that are paying at least 5% right now. And number 1, we look at Dominion Energy. The ticker symbol on this is D, which of course is an energy company, but has a dividend yield of 5.5%. And of course, the utility provides very, very stable income because a majority of it is backed by government regulated rate structures. And of course, the really need for stable electricity, the demand is always going to be there for energy, for electricity. Its focus is providing dividend strategy and really investing, as well as expanding its operation and transitioning into a power fleet, which is low carbon energy. So again, looking at this, now those investments should grow about 5 to 7% with an annual rate. And they are also increasing dividends, which means if you're looking to buy a high dividend yield stock, this is a pretty good buy, because not only do they have a pretty good dividends, but they're also going to be increasing it in the future, which puts them in a good position to go ahead and grow it. Now, when we look at bigger growth, looking at Enbridge. Now, if you're familiar with Enbridge, which I am, it is a Canadian pipeline utility. So again, looking at a utility, ticker symbol on this one is ENB, and this is currently paying over 7.5%. So again, when you think in relationship to CDs, when you think of high yield savings, 7.5% is a pretty good yield on a stock. And of course, very predictable income, again, backed by long-term contracts, government regulated rate structures to actually provide the utilities within there. This gives the fuel to pay dividends for many years to come, and also growing dividends in the future. Now, of course, when you look at the multi-billion-dollar backing, there are a lot of expansive projects that are underway from these companies, because again, they're both large utility companies, and they're also expecting about a 3% annual growth rate through 2026, which means putting money into it today, not only are you going to see the dividend yield and an increased dividend yield, but again, you could also see the stock appreciation go up as well, which this has paid dividends for 29 straight years. So if you want to talk about something that has paid for almost 30 years, this is a pretty good investment. And of course, when we talk about investments living up to its name, Realty Income, this ticker symbol, we've talked about this one before, is O. Now, this has a dividend yield of roughly 6%. This is the real estate investment trust, which is a REIT. Now, if you look at this, it is a dividend portfolio of income producing. It has commercial properties, which supplies a really big, heavy cash flow, which of course, when you start looking at this company itself and you break down their holdings, they have some major brands within the United States, which of course pays its monthly dividends, which has declared its 126th dividend since going public in 1994. So again, you're looking at 20 years of dividend, which by then it was paying out 4.3%. And now it is approaching 6%. So we have also seen the appreciation not only of the stock itself, we have also seen the appreciation of the dividend growth as well. Now, when you look at this, it's continuing to grow the dividends. It is expected cash flow of 4 to 5% annually. And of course, rent is going up, property acquisition is going up, more companies need places. They've also started going into new property types, including gaming and data centers, and also looking at different regions. Additionally, adding European countries to go ahead and grow that portfolio. So not only are they just in the US, but now they've actually expanded to a couple other places outside of the United States. And of course, when we get into the health side, the healthy dividend, of course, is Pfizer. Now, of course, if you're familiar with COVID and the vaccine, they currently offer a dividend yield of roughly 6%. Pharmaceutical giant has 342 consecutive quarterly dividend payments. That is crazy. That is right. It has delivered its 15th straight year of dividends, which of course was late last year. Company also invested heavily growing in the business, which it bought Seagen, which was a $43 billion blockbuster deal. So of course, Pfizer wants to double the number of cancer patients that they're treating. And of course, if there are any medical breakthroughs, if there's anything really cutting edge that they can get into, that is going to really appreciate the stock value as well as the dividend growth that we see in the future. And of course, they are looking to do this by 2030, which means within the next 6 years, we should see a lot of other blockbuster medicines. And of course, we know it was one of the biggest companies for the COVID vaccine, which really was a game changer. So looking at the investment and what they're doing with groundbreaking technology, they're going to continue to grow up those earnings and also continue the dividends and the cash flow. And one of my favorites that, again, we have covered before, the cash flow machine, which is Verizon. So when you look at the ticker symbol of this one, it is VZ. Dividend yield over 6.5%. So very similar. We see Verizon kind of going hand in hand with AT&T. It is a telecommunications giant that has a ton of cash flow, which is used to not only reinvest in the business, to pay dividends, strengthening the balance sheet. They generated almost $19 billion in free cash flow, which is kind of crazy after capital expenses, and easily covered $11 billion in dividend payments, which they covered very easily. And the excessive cash flow, which again was almost $8 billion, was really lowering the leverage ratio. They bought some of the stock back. Now, of course, the telecom giant has great record of increasing the dividends. It has done 17 consecutive annual dividend increases late last year. So it was the 17th increase. So even if they already are at 6.5 for a yield, they are going to continue to increasing this yield, which is kind of crazy, which is the longest current streak in the US telecom sector, which again, comparing Verizon into AT&T, Verizon has really exceeded when it comes to the dividends and when it comes to that reinvestment. Now, this trend upward should continue. And of course, Verizon's investment into 5G, growing revenue. Meanwhile, their cost reduction strategies and debt repayment is going to boost the cash flow for years to come. Now, of course, when you look at all 5 of these, dividend stocks are a very good source of passive income. Even looking at some of the HD, looking at the JEPI, these are providing a much higher dividend yield than we are seeing with those ETFs. And they are really offering those above average income streams if you're looking at doing this. Now, of course, when it comes to stocks like this, when it comes to a portfolio, this is just in addition, and this is actually a portion of the portfolio. If you checked out my 3 ETF portfolio, this could possibly be some companies that you're adding at a very small percentage, making rock solid growth within these companies, and of course, headed for higher future dividend yields, which would be really good for those income seekers. And again, looking at the breakout in the portfolio itself, you do want a portion that is going to be allocated to really the generation of income, which is very important because if we see the tech sector kind of do some of the pullback, which is kind of expected, you're not going to see the same from the dividend stocks. You're not going to be seeing a lot from those blue chip stocks, which is the reason why we do go ahead and leverage and really miss risk mitigation when it comes to our investing strategy, making sure the diversification is there. And of course, these high dividend yields that we talked about can definitely offer you some diversification. Even if you put, let's say, 2% of a portfolio into 5 different stocks, roughly 10% of your portfolio allocated to the passive income generation, and then going in for ETFs, going in for a bunch of different things could really make a big, big difference. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.